Good afternoon, and welcome to the November meeting. Before we begin, a quick reminder that no new data or figures have been introduced since October 8th, the date of our first submission. Now, after more than a year on pause, the Fed took its first steps towards easing earlier this year in September, cutting the federal funds rate by 25 basis points to a range of 4.0 to 4.25%. Balance sheet runoff continues, but at a slower pace.
Inflation has cooled from 2022 highs, but has trended upwards over the past few months. Headline PCE was 2.7% in August, driven upwards by sticky services like housing and healthcare.
The labor market tells a different story. Unemployment rose slightly to 4.3% in August, while job growth nearly stalled. Only 22,000 jobs were added.
And the backdrop is further complicated by tariffs, which risk pushing up goods prices, while demand-side factors continue to provide inflationary pressures to the economy.
So the Fed's challenge is clear. Should we ease monetary policy to safeguard employment in an already fragile economic environment, or hold rates steady to prevent a resurgence in inflation? With that, let's turn to our first section on tariffs and trade disputes.
Now, an ever-changing tariff landscape stands out as one of the major new forces shaping economic outlook. Just a few weeks ago, new measures were announced: a 100% tariff on patented pharmaceuticals and a 25% levy on heavy trucks. These add on to existing duties from earlier trade disputes.
By pushing up inflation and depressing growth, tariffs put the dual mandate directly in tension. As of now, considerable uncertainty remains about how much and how quickly tariffs will translate to consumer prices, distribution networks, and supply chains.
But tariffs are not always a standard supply shock, as shown in a 2025 working paper by economists Bianchi and Coulibaly. Tariffs create a distortion because individual stakeholders do not internalize that higher imports lead to higher government revenue, which is ultimately rebated by raising household income. Hence, to counteract the substitution effect of tariffs, Bianchi and Coulibaly advocate for a rate cut, overheating the economy, stimulating employment, and raising aggregate income.
But the optimal monetary policy response to tariffs can vary in a case-by-case scenario. In a paper published in 2023 by economists Bergen and Corsetti in the Journal of International Economics, they noted for a two-country tariff framework, while the optimal response may be expansionary for the tariff-targeted country, or in the case of symmetric trade wars, contractionary policy would still be most successful in bringing down prices for a tariff-imposing country.
So, in a sense, tariffs amplify uncertainty and risk reigniting inflation at a time when price stability is already fragile. This tension reinforces the challenge of balancing risks on both sides of our dual mandate and sets the stage for our inflation outlook.
The PCE price index rose to 2.7% in August, while core PCE remained at an even higher level of 2.9%. So with inflation still above the Fed's 2% target, any further easing warrants greater caution.
The Atlanta Fed and Yale Budget Lab estimate about a 1.3 to 1.8% increase in consumer prices as a result of the tariffs. And at the same time, we are gradually witnessing spillover effects from the tariffs onto domestically sourced goods because of more expensive inputs. The Fed still nonetheless believes that this is in line with a one-time shift base case.
And currently, PC goods inflation sits around 0.86%, while PC service inflation sits around 3.61%. The non-housing core service inflation rose threefold to that of core goods prices over the last year, contributing 1.9% to core PCE. With tariffs slowly passing through and sticky services making up a large proportion of inflation, we cannot yet fully see through inflation.
Furthermore, this will not be a one-time shift if tariffs propel inflation expectations upwards, eventually pushing real inflation up.
Near and longer-term inflation expectations are elevated but broadly stable. The New York Fed survey of consumer expectations shows a one-year ahead reading of 3.2%, which is well above target but not drastically rising. On the other hand, in the bond market, the five-year forward rate is well below this level at 2.2%, which shows that institutional investors do not foresee long-term inflation.
However, elevated near-term consumer expectations raise the risk that inflation becomes self-reinforcing. Gallup reports that 89% of adults expect tariff-driven price increases, while the forecasted pass-through rates of tariffs to prices have risen by 20% to 50% in August. With risk skewed upwards, further cuts are hard to justify. Holding rates at a moderately restricted stance could anchor expectations, though we must weigh this against signs of labor market cooling.
Let's turn to the labor market data. The unemployment rate rose to 4.3% in August, up slightly from a level of 4.2% in the year prior.
Labor force participation rate is at 62.3%, trending downwards and below pre-pandemic levels. Tighter immigration restrictions may be reducing labor supply growth, masking underlying weakness.
However, the prime age labor force participation rate has rebounded to near cycle highs according to August estimates, suggesting that immigration changes have smaller net effects on the core of the workforce than previously estimated.
Non-farm payrolls also barely moved in August, up 22,000, and combined with the meager gains we saw in May and July, the June decline, and the 911,000 benchmark revision we saw from last year's data, it points to a labor market that was weakening well before the recent tariff shock hit. And we can already see this in some certain demographics. For instance, the 20 to 24-year-old age group, which are typically early in their career and just entering the workforce, have seen their unemployment rate rise to 9.2%, which is perfectly in line with my graduation year.
Even with revisions, limited labor supply suggests that there isn't much slack, as Chair Powell has noted. Payroll gains also do not fall drastically short of the break-even figure provided by the American Enterprise Institute, which is 32,000, given the net immigration is negative.
Now, BLS reports stable layoffs over the past year. However, ADP estimates show that private payrolls fell by 32,000 in September 2025, the largest drop since March 2023. Consumer anxiety reflects this. The New York Fed estimates that the perceived risk of job loss in the next 12 months rose to 14.5%.
Yet, BLS also reports that jobless claims fell to 218,000 in the week ending September 20th, a 2-month low and well below consensus and estimates. Nonetheless, with claims data known to be noisy, policy change should wait until a clear trend is established.
While the number of unemployed persons for job opening has risen steadily over the post-pandemic period, its current 1.0 figures suggest that the labor market is still in balance.
But despite this relative balance, recent job growth has been concentrated in a few industries. The vast majority of job growth in the last 6 months has come from private education and health services, with limited growth or even contraction in some other sectors.
So overall, the labor market appears to be in balance, but merely as a result of a weakening labor supply and labor demand. This makes tighter policy harder to justify, though with inflation risks skewed upwards, we turn to growth to paint a full picture of the economy and see how to further balance our dual mandate.
In Q2 2025, real GDP grew at a rate of 3.8% annualized, the fastest in 2 years. A smaller trade deficit added a record 4.83 percentage points to GDP growth by Q2. Strong consumer spending carried much of the upward trends in growth, while services remained solid. To me, this forecasts resilience that shouldn't be ignored.
Resilience on the surface may be, but the composition tells a different story. Now, private investment has fallen, both on the residential side, with mortgage rates being high at 7%, as well as on the business investment side, where high borrowing costs and tariff uncertainty weigh heavily on firms' decisions. This entire picture of high consumption, low imports, and weak investment doesn't paint a picture of durable growth.
So although the consumer sector has surprised to the upside, private investment remains weak. One potential offset, however, is AI. Goldman Sachs economists estimate that AI could boost productivity from a level of 0.3 to a full 3% over the next decade.
But AI presents long-run potential, not a near-term fix. The IMF warns that AI's gains will be concentrated in top firms and advanced sectors, leaving many regions and workers behind. Even today's consumption is uneven. Moody's Analytics estimates that 50% of all spending comes from the top 10% of households. Now, that doesn't predict broad-based durable growth.
That's a fair point, especially considering that the OECD predicts the US annual real GDP growth rate to be 1.8% in 2025, but just 1.5% over the next year. So we're left with a mixed picture. Upside potential from innovation, but downside risks due to structural headwinds and weak private investment.
That is why the Fed walks a tightrope. Cutting prematurely might risk inflation, while tightening further could stall growth. Forecasts support holding rates and adopting a wait-and-see approach for clearer data. For now, let's turn to how these conditions transmit through markets.
Now, the Cleveland Fed estimates nominal R-star, or the neutral rate of interest, to be at 3.7%, which when adjusted for inflation expectations aligns with the real rate that we see here. This implies that policy is already restrictive. Beyond this, the San Francisco Fed suggests that demographics, current sluggish productivity growth, and global savings could be applying downward pressure on R-star in the long run. This means that policy is tighter than anticipated, and caution is warranted.
However, with inflation elevated, tariffs adding uncertainty, and inflation expectations rising, policy should remain restrictive until sustained progress is clear.
But the restrictive effects of holding rates steady, as R star seems to be declining over the long run, can already be seen in the housing markets. Although recent rate cuts have eased financial conditions, mortgage rates remain relatively high, as indicated by the left axis, and building permits are declining as builders pull back, as seen on the right axis.
In credit markets, the negative NFCI shows that credit is still historically loose on market metrics, at least relative to pre-tariffs. But banks are starting to tighten lending standards on commercial and industrial loans and credit card loans, which would only amplify the effects of restrictive policy. Tighter lending also dampens the effects of expansionary policy, as lower rates do not as strongly correspond with greater borrowing.
Housing, credit, and labor market data point to restrictive conditions. But we also know our most recent rate cut will impact markets with a lag. Meanwhile, inflation is still above the Fed's 2% target. So holding rates steady, as R star seems to be declining over the long run, may keep inflation anchored.
Now, let's turn to the Fed's balance sheet. Today, it sits around $6.6 trillion, or around 22% of GDP, consistent with the FOMC's plan issued in May 2022 to return to an ample reserve system. The Fed has been actively reducing the size of its balance sheet for nearly 3 years. The Fed currently operates with abundant reserves, meaning that the reserves, according to the New York Fed, exceed 12 to 13% of the Fed's assets.
The Fed currently holds about $2.7 trillion in reserve balances, while its asset portfolio remains skewed towards longer dated maturities. This means that if the interest rates that the Fed pays in these short-term assets rise above what the Fed is currently earning on these longer-term assets, the Fed suffers a loss, as has happened in 2022. So what some have suggested, such as Governor Waller, is that the Fed back bank reserves solely with short-term assets to better align the interest in its assets and liabilities and prevent future losses.
Moving the Fed's portfolio to its shorter-term securities will be a slow process, unless the Fed sells existing securities and replaces them with Treasury bills. What we must consider then is, should the Fed slow down tightening?
Slowing down QT in times of economic uncertainty remain particularly important due to the liquidity effects of QT. In a paper from 2023 by economists Andrew Lee Smith and Victor Valcarcel, published in the Journal of Economic Dynamics and Control, they found that the liquidity effects of QT roughly double those of QE. And this happens because when the Fed first begins to tighten, reserves will still be well above a minimum demand for reserves in the banking system. But as the Fed continues tightening, each additional dollar drained will have a bigger impact on interest rates.
And since we don't yet know how markets will respond to changes in tariff policy, or immigration policy for that matter, slowing quantitative tightening would allow the Fed to keep enough liquidity in the system to absorb potential shocks to the economy.
Now, let's move on to a recommendation. With inflation elevated and GDP growth showing resilience, the FOMC should hold rates steady at this meeting. Clearly, the upside risks to inflation outweigh the recent labor market softening, especially as tariffs have yet to fully materialize within the economy.
I disagree. While inflation is elevated, inflation expectations are broadly stable. Meanwhile, the job gains are narrow and concentrated in a few industries. Investment is concentrated in AI, and the top 10% of consumers are increasingly driving consumer spending. With the labor market deteriorating and housing lacking any meaningful correction, the FOMC should cut rates by 25 basis points.
Now, both your views reinforce this delicate balance we face between persistent inflation risks and labor market softening. In balancing the dual mandate, the committee will hold the federal funds rate at a rate of 4.0 to 4.25%, remaining prepared to adjust policy in either direction if necessary.
Okay, but would holding rates steady strengthen our inflation-fighting credibility or risk signaling complacency as the labor market deteriorates?
That's a fair question. Provided the Fed's most recent rate cut to remedy labor market weakness and inflation still well above our 2% target, we place greater weight on restoring the price stability aspect of a dual mandate. Holding rates can allow expectations to continue to be anchored while also allowing for adjustments as conditions evolve.
Okay, I agree with that assessment. However, the committee stands ready to resume rate cuts to pursue the maximum employment side of our dual mandate if the labor market continues to weaken, and of course, guided by incoming data.
Finally, the committee will continue replacing existing securities with short-term Treasury bills to best support the maturity structure of an ample reserve system and slow down tightening so long as conditions remain restrictive. With that being said, this meeting is adjourned.
Thank you for your presentation. We have a number of questions for you. First, we wanted to focus on the labor market. We've seen monthly job gains move sharply lower this year relative to last year's period, while at the same time, the unemployment rate has only moved up a bit. How are these observations consistent, and what are the implications for monetary policy?
Right. Thank you for the question. Now, we have seen the labor market has been softening from a weaker hiring standpoint. We started this year at 148,000 jobs in January 2025, but have now stagnated at 22,000 in August 2025. This represents a significant decline in these job gains. However, on the other side, unemployment has only risen by 10 basis points in the last year, from a rate of 4.2% last year to a rate of 4.3% this year. Now, as you mentioned, this kind of represents a dichotomy in the labor market, which can be resolved by a few structural factors. One of these could be immigration. Now, we know that immigration surged post-pandemic. The years from 23 to 2024 showed a net immigration of 2.6 million. And as reported by Brookings, this accounted for 50% of payroll employment gains. However, in the current environment where immigration has been slowing because of tighter immigration restrictions, less temporary visa authorizations being issued, we have seen that because the labor force isn't growing as strongly, we have fewer new job seekers. And so the denominator in the unemployment rate isn't really moving. Hence, the unemployment rate barely moves. This essentially means that even though there are more jobs available, there aren't as many new job seekers, and this could kind of attribute to that very slow rise in unemployment rate.
So what we see, as we have mentioned in our presentation, is that the unemployment rate has remained broadly stable due to a weakening in labor supply and labor demand. But we do see that there are some structural factors that are operating in the labor market that monetary policy may not be able to capture just yet. For example, wage growth in the labor market for people switching jobs has fallen, which is what we see consistent with a weakening labor market, not with a strong labor market where there is an increase in demand for labor, so wages are growing. So these sorts of indications suggest that our labor market is weakening regardless of a stable unemployment rate.
And even though the labor market has been softening, in our presentation, we mentioned the break-even unemployment rate for number of job openings, which sits around 32,000. Even though we see that job openings have been declining over this entire year, and with the government shutdown, we don't have a lot of data. We can also reference other data sources, such as the ADP National Employment Report, which suggests that job openings have been around 40,000, which is still above that break-even rate, suggesting that there's still a balance in the labor market with labor supply and labor demand.
So altogether, just repeating what my teammates said and rehashing everything together, we are seeing low hiring as well as low supply as well as low demand for the labor market. So those act in tandem with each other. This contributes to things like the number of unemployed persons with job opening being 1.0, which is a measure of balance together. So in terms of the implications for monetary policy, this is why we believe that holding rates steady could be a meaningful move as we wait for further weakening in the labor market, since the unemployment rate has relatively steady, even though it is relatively high at the same time. At the same time, we will also continue to slow down QT, which could be a further offset to the labor market to bring in some stimulative effects, even though as interest rates could be moderately restrictive.
Thank you. Two-part question, and so shift your mind to financial markets. How should policymakers take into account signals from financial markets, such as stock valuations and credit spreads, when deciding on the appropriate stance of monetary policy? If changes in financial markets have different implications for monetary policy and financial stability, how should policymakers weigh the trade-offs?
Thank you for the question. Now, we understand that the US stock market has surged across 2024 to 2025. We have seen the NASDAQ up 25% year to date, with 2/3 of S&P 500 gains concentrated in AI-related firms. In addition to this, we have seen the market capitalization to GDP, or the Buffett indicator, is also at record highs. Now, and this comes at the time when economic data is kind of softening. We are seeing hiring slow at 22,000. We are seeing services inflation remain sticky at 3.6%. Now, in this particular situation where we have booming equities from the NASDAQ up 25%, financial conditions are easing overall aggregate conditions more than the Fed intended. This is mainly because of the wealth effect, because households that hold these assets feel richer as stock prices increase, which increases household consumption, which will cause firms to hire and invest more, thereby loosening conditions overall. Now, at this time, when we are seeing easing through optimism and liquidity, it is up to the Fed to hold rates steady and maintain a more restrictive stance to counteract the effects of these easing equity markets.
Yeah, and kind of building off that, my colleague mentioned the wealth effect, and that points to where the richest tend to get wealthier because they hold more of that assets. And when we have bubbles, it means that popping potential bubbles could actually impact the lower income workers a little bit more, because instead of pushing, the recession is going to be bound to happen anyways, but instead of pushing it off, we are just making it happen now. So it hurts low income workers in the short run in order to benefit, or in order to pop the bubble that we might not even know is necessarily a bubble.
Further expand on why the financial market might have certain important implications for monetary policy, one very important indicator could be the 5-year Fed forward rate, which essentially reflects the break-even inflation rate that the markets are pricing in, which would be nominal treasury yields minus tips treasury to protect the securities. Essentially, that inflation, break-even inflation that financial markets are responding to and pricing in reflects review preference, which is what they expect the inflation expectations to come in 5 years from now over a 5-year time period. As a result of that, because you're having money in the market, it is sometimes considered a more accurate reflection of inflation expectations, and is therefore one of the really important indicators that the Fed should look at when they consider whether they should pursue further easing in the monetary policy that could potentially risk higher inflation, or they should hold rates steady, which is what we recommend given the other inflation expectations are moving different directions.
So when we are considering whether the Fed should be looking into financial markets or taking financial market data into account when determining what to do about rates, we must always return to the dual mandate of the Fed of price stability and maximum employment. Although, as my colleagues have mentioned, data from financial markets can be indicative of investor expectations in the economy and sentiment, financial markets are also subject to considerable volatility, as we have seen, for example, following Liberation Day tariffs and the spike in volatility that we see in the markets.
I also just want to add one more thing about another metric that's pretty important for consumer sentiment and consumer resilience, which is also the 30-year fixed mortgage rate, as the FOMC can indirectly influence that specific mortgage rate, especially given that mortgages are sitting around 6.34%, meaning that mortgages are relatively pretty unaffordable, and we see that a lot of buyers are reluctant on buying homes, and a lot of builders are pulling back essentially. And the reason why we advocate for slowing down QT is we can allow those rates to go down over time, essentially allowing more affordability in the housing system and allow stronger spending in the long run.
Great. Did any of you want to comment on how policymakers should weigh the trade-offs between monetary policy and financial stability?
Yes. So we understand that the Fed does not directly track the stock market. However, the Fed is to remain cognizant about financial instability risks. And a situation like this does pose a risk to financial instability. So in this area, for instance, as my colleague mentioned, there is a potential of an AI asset bubble forming. Now, with this AI asset bubble forming, with private investment up 40% in AI infrastructure and data centers, as reported by the BEA, as well as venture capital funding increasing 2x in AI startups, even though these startups aren't really producing any profit yet, this kind of shows that valuations are far higher than fundamentals. And when this bubble keeps expanding, this poses a risk of, if the bubble pops, that is, if investors lose confidence, then stock prices could fall, household wealth drops, by the wealth effect, consumption drops, and this could lead to a further deteriorating labor market. However, in evaluating this trade-off, now even though the Fed is not supposed to track stock markets directly, it will try to look at the overall financial stability of our financial systems. And hence, in keeping rates low, the Fed may run the risk of increasing optimism in stock markets and thereby increasing investment, thereby expanding the bubble. So while the Fed should not pop the bubble directly by raising rate hikes, as it has to maintain an overall view of the aggregate economy, they should use forward guidance and maintain a moderately restrictive stance so as to help support innovation while also keeping financial instability risks at bay.
There's also a lot of uncertainty over whether it's a bubble in the first place. As Powell noted in the October press conference, the AI isn't necessarily a bubble because companies, unlike the dot-com bubble where it was based on ideas, the companies have consistent revenue from these AI sources. So we don't really know if it is a bubble, and as a result, it's hard to make monetary policy over speculation, and we should be focusing on the current data that we have instead.
Thank you.
Thank you very much. I would like to expand further on topic of your presentation. You mentioned R-star and you pointed out to its current level. Can you elaborate further in what do we know about the actual level of R-star and the uncertainty around it, and which are the main drivers that policymakers should take into account to assess where R-star is going?
So when thinking about R-star, we noticed from our presentation that the real rate has been decreasing, and that is a result of the past decades of what we saw as secular stagnation, which was driven by low innovation, lack of innovation, certain demographics such as an aging population. So we mentioned in our presentation that R-star, nominal R-star, seems to be declining over the long run, and we also saw in our presentation that real R-star has been declining over the long run as well.
And another proponent of what's driving R-star up recently is also the federal deficit, which has been reaching unsustainable levels. And in order to sustain this debt, the government has to issue out treasury securities. In order to incentivize people to save and invest in these safer assets, the R-star naturally would have to be higher for that in the first case. And another reason, another reason why R-star has been trending upward is from AI productivity gains as well, which I'm going to talk a little bit more about the employment side as well. In the short run, there might be a more nuanced argument that increased productivity could lead to disinflation or deflationary effects as there's higher average capital per worker, meaning that firms don't need as many workers to produce that same amount of output on the production frontier. So that means that we could see some layoffs or some less job openings. But in the long run, as new skills, new jobs are created, this could allow people to get new jobs and basically counteract that disinflation or deflationary pressures and push up R-star as productivity and output go up in the long run.
Yeah, as we know, the R-star has been declining over the long run, but especially in the recent 2020-2025 period, we have seen that R-star has continued to increase. And a lot of that is, as we mentioned, AI, right? Especially as a lot of companies, AI is incredibly capital intensive. You have to build out your data centers and all this infrastructure. And as a result, that pushes up the demand for funds. And consequently, R-star begins to rise. So it's unclear of whether this trend will continue, but yeah, as of now, it is increasing.
The relevance of R-star to monetary policy and Fed decision-making could be more of an indirect force. So R-star helps us interpret whether monetary policy leans more towards tighter or looser. As we're seeing now, monetary policy is probably more on the restrictive end because our federal funds rate does exceed what the neutral rate of interest would suggest. Or if it ever dips below, it might suggest that policy is more more accommodative. So essentially, it might actually matter a bit more for the Fed to take note of what is driving up R-star up or down in the short and long term. And these are the forces that could further inform Fed decision-making and monetary policy.
And then with regard to these drivers that my colleague mentioned, we know, as my other colleagues have mentioned, that R-star is declining in the long run. But in the last 5 years, we've seen an uptick in R-star. Now, main drivers for this decline include aging demographics. We have slower productivity growth, as well as global savings. However, in the last 5 to 6 years, we have seen an uptick in R-star. Main drivers for this, of course, are the downward pressures, like, for instance, aging population. These downward pressures have kind of released. We have also seen higher government spending over the pandemic in order to have fiscal stimulus in the economy. We also see a greater appetite for risk, as we have seen the NASDAQ up 25%. This increases investment demand, in addition to other policies like fiscal policy, as well as the estimated productivity gains from AI.
Right, thanks for this. So in the remaining time, let me just follow up quickly on some of the labor market issues. So you talked a lot about the stocks, employment, unemployment. So can you talk a little bit about the flows, the vacancy rates, the hiring rates, the quit rates, and how you see them informing the current labor market outlook?
Yeah, we saw in a lot of the most recent hiring data that a lot of the gains in labor market, as we mentioned in our presentation, are incredibly concentrated in the private healthcare or private education and health industry, specifically mostly driven by that healthcare side. And we can see this in things like the labor market diffusion index, which historically is above in non-recessionary periods. It's between 60 and 70, and right now it's in 49.2, which indicates that more firms are contracting rather than expanding. So even if we have seen these gains, they are very minimal and they're very concentrated in a few industries as well.
So more onto the private sector job growth, we saw that the average over May, June, and July was about 52,000, which is half of what we saw last year. So even though we essentially lead with public data, looking at private sector seems to indicate a better underlying understanding of what is happening in the economy, as suggested by Governor Waller earlier in August.
Especially, and if hiring trends slowing down for certain age demographics, as mentioned earlier in the presentation, especially for the 20 to 24-year-old range, that does suggest that firms are cutting back on hiring.
Time.
Thank you very much.